Oil hits a new wartime high on concerns the U.S. may resume attacks against Iran. The U.S. military has asked for hypersonic missiles to be sent to the Middle East, the first time those weapons have been deployed.
Hello and welcome to the Week Ahead on Nomura Podcasts. I'm your host, Andrew Ticehurst from our Global Markets Research team, and today's Friday the 1st of May. Markets have been jumping around this week with lots of fresh news, making it hard to keep up. We have seen the oil price move up net amid the current US-Iran standoff, and US bond yields have moved up with oil as markets think about the inflation and policy rate implications of higher oil prices. The UK 10-year and US 30-year government bond yield both moved up, touching 5% this week. And we've also seen US equities move higher too, and up now an impressive 10% over the month of April. Quite the rebound, with US data generally resilient and with some ongoing tech AI support. Meanwhile, over in Europe, the Bank of England and ECB appeared less hawkish than feared, but our research team have revised up their cash rate profiles there. And in FX space, dollar yen moved up above 160 this week, but we have just had reports of official intervention and we're seeing a sharp retracement lower there. This week, we're going to do a quick recap of the key central bank meetings we've seen this week and how that's shaping our outlook. We'll also be previewing central bank meetings in Malaysia and Australia next week. And we'll provide our forecasts for some of the key upcoming data releases, including earnings releases in Japan and the coming US April Payrolls report. Joining me on the podcast this week to discuss all of this and more will be David Seif, Nomura's Chief Economist for Developed Markets in New York, along with other members of our global research team. Josie Anderson in London, Yoichiro Nozaki in Tokyo, and Iru Chen in Singapore. And finally, over recent weeks, we've been discussing the macro implications of the oil shock and likely central bank responses. And this week, we've got a special guest interview for you with Jon Cohn, our US rate strategist from our global markets business. He'll be joining us and offering a market perspective. You don't want to miss that. Plenty to discuss, I think. So let's dive in.
Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook, and we will remain attentive to risks to both sides of our dual mandate.
Okay, so let's get going. We'll start with the US, and I'm joined here by David Seif, Nomura's Chief Economist for Developed Markets. David, welcome back.
Great to be here. Hey, Andrew.
Yeah, excellent. Big week. So it's great that we've got you on. Look, let's start with the FOMC meeting this week. Can you give us a quick recap? What were the highlights for you?
Yeah, well, I mean, this was, of course, Powell's last meeting, and so it had a very atypical dynamic to it. If we look at things without taking that into account at first, the statement itself was arguably a little bit more dovish than we had expected. It did not really, in our opinion, fully mark to market the improvement in the data. And it did retain the dovish bias or the cutting bias, which we had expected, but we did at least see some risks that that would be removed. Of course, on the other side of the coin, we had three hawkish dissents. And interestingly, with Governor Myron dissenting to the dovish side, 4 total dissents, the most that any Fed meeting has had since 1992. The key thing here, though, were the 3 hawkish dissents where there was an explicit dissent against keeping the easing bias in there by 3 relatively hawkish regional Fed presidents. Our take was that, to the extent that Powell can really signal the future, given that he is stepping down as chair. More on that in a minute. We didn't find that he really defended the dovish stance of the statement all that much, and so there was a little bit of a disconnect between the statement having these strong dovish tones to it, but Powell not really getting up there and being prepared to sort of pound the table that this was the view. Now, of course, the other thing we got from this meeting was from the press conference was Powell's statement that he will remain as a governor even after his term as chair ends. And he really, he was very explicit that this was to make sure that the investigation against the Fed was well and truly over, because although the investigation has been dropped, U.S. Attorney Jeanine Pirro has left open some conditions under which she could reopen it. And so it looks to us as though Powell could easily stay for a couple of months, maybe a meeting or two. He's promised to be a low-profile governor, made it clear he won't be any sort of a shadow chair, but that could delay, or it will delay, that seat being filled by yet another Trump appointee. And so, that is one fewer potentially friendly seat, friendly governor for President Trump on the Fed for the time being.
Okay, got it. And switching to the data front, we had a bunch of releases this week, but the GDP report caught my eye. That was softer in the headline, at least. What's your take there? What's that saying about the economy?
Yeah, well, the GDP number was a little bit softer than consensus. I think when you dig into the details, though, it really was a pretty robust number. So many of the downside surprises, at least from Nomura's take, was that we didn't have as much inventory investment as we had expected. In fact, we had quite a bit less. And then we had expected the contribution from government spending, much of which we had expected to come from a rebound from the shutdown-induced negative number in Q4. We had expected that to be a bigger impact in Q1 than it ended up being. When you sort of strip out all the what we could call volatile components, inventory investment, net exports, and government spending, then we did have real final sales to private domestic purchasers rebound to 2.5% on a Q-over-Q basis in Q1, and that was actually even above our forecast. So although the headline number for GDP was a little soft, I think the fundamentals of it were actually quite robust, and it shows that the private sector really did remain solid from an economic activity perspective.
Okay, got it. Yeah, so underlying demand there still holding up pretty well. Yeah, I guess a lot of the US data have been pretty resilient. And look, finally, David, just on the data front, this is the Week Ahead podcast, of course, so we should talk about payrolls. That's probably the highlight next week. Do you have a forecast for that one?
Yeah, certainly not a Week in Review podcast. We, of course, do have a forecast for payrolls next week. We expect that payroll growth was 70,000 in April. That is, of course, a major deceleration from what was a really blowout number in March. But still, it's actually above the consensus, which is at this point 60K. Of course, that could change over time. So, and we think it's still would represent a modest acceleration in underlying employment trends. But there has to be somewhat of a negative payback after the extremely strong March. Now, key to this is that is enough, given how close the unemployment rate was to rounding down to 4.2% last month, to actually bring the unemployment rate down. So our forecast is that the unemployment rate will fall to 4.2%. That's below the current consensus. And should be yet another measure of strengthening hiring and a very low level of layoffs. Another piece of data that we got that came actually at the exact same time as GDP were continuing jobless claims for the week ending April 18th, which is important because that's the reference week for this non-farm payrolls print. And it was actually the lowest in 2 years. So that is just another indicator that the stock of unemployed people seems to be going down a little bit. And not only does the labor market no longer appear to be really decelerating, if anything, it looks like it may be accelerating a little bit. One other thing I'll just tack on is that we also do expect that average hourly earnings remain subdued for a second consecutive month. And we expect there to be just a 0.2% increase for a second month in a row. That is below consensus on that. But still, in aggregate, when you look at our non-farm payrolls number, it would still lead to a solid growth in total payroll income.
Okay, good one. David, thanks so much, and good luck for the week ahead.
My pleasure. Thanks a lot, Andrew.
Now, to our special guest, Jon Cohn. Jon's our US rate strategist sitting in Nomura's dealing room in New York. I should note that as a desk strategist, Jon's part of our global markets business, but not one of our global research team members like the other speakers you hear from. So what you hear from Jon is certainly not investment advice. But with that introduction, Jon, let's get stuck in. Look, it's so great to get you on the podcast. I've been fascinated by some of the moves in markets of late and some shifting correlations. It seems that risk assets in general holding up pretty well in the face of some net upward move in oil and amid, I guess, a continuing standoff between US and Iran. But look, still, it seems that US bonds and certainly the short end of the US curve is paying attention to oil and inflation and Fed funds implications. Is that fair? What's your take?
Thanks, Andrew, and great to be back on. Yeah, risk assets certainly have held up better through much of the rebound this month. And I would note there, a lot of it has been tech driven, so it's not necessarily as broad based as maybe you might suspect. But as you mentioned, the rates market, especially the front end in particular, remains captive to the risks and uncertainty around the Middle East conflict. The Fed most recently suggested that its reaction function is a little bit more symmetric as opposed to biased towards cuts, which we can certainly see in the flat implied policy path, as well as in the option skew. An implied terminal rate fairly close to spot also points to a much weaker magnetic pull from the neutral rate down. So now I think it's important to take a closer look at the shape of the strip. And this shows that the protracted conflict alongside what we've gotten in terms of resilient economic data has eased the sense of urgency for a hawkish policy response, especially compared to a month ago. To the extent markets are considering hikes, it's later, right? It's into Q1, Q2 next year as opposed to this year. Remember, markets priced as much as 15 basis points of hikes into 2026 amid the positioning washout in March. Fed emphasis on patience, I think, has really had a pinning effect at the front end. We can still see some modest policy mistake kind of pricing through 28, meaning hikes followed by cuts, but it's much less aggressive than a month ago. So put simply, the market pricing is now for a higher for longer outlook with a lower peak and a higher valley. The Fed can't be, I think, too unhappy with this backdrop for now, even if the market maybe kicked the can farther than the majority might have. My opinion, I don't get the value in hiking into a supply shock, as rate policy is best used to address demand, not supply concerns. So I do still think there's good reason for the market to maintain an expectation for an asymmetrically dovish reaction function. We got Warsh coming in, got longer term inflation expectations anchored, and we've got a Fed that historically has shown a lot of flexibility with its category of inflation emphasis.
Okay, good one. Gosh, a lot in there. Hey, look, let's just drill in on the conflict and Trump. It seems like we've been, over the prior month or two, we've been almost fixated by the daily pronouncements from Mr. Trump, but it seems that markets are reacting less to those of late. Are you seeing that too?
Yeah, that's spot on. I think weeks of back and forth geopolitical headlines have sort of battered, especially the rates market, into a state of battle fatigue. Conviction is obviously, and I think understandably, quite challenged given this headline risk, and the market seems to be less responsive to economic data as well. Risk takers certainly seem more cautious as well, and I think part of that, owes to some hangover from the washout in March that I had mentioned. You'll recall the massive front-end led sell-off and pop and vol across US, Europe, UK rates, and offsides positioning really accelerated that move in March. And you saw pain in other popular trades as well, the kind of leverage carry, implied short expressions like swap spreads. We went from pricing 2.5 cuts by year end at the end of February to an implied Fed path now that's basically flat as a pancake. And implied volatility across much of the grid had really returned to levels seen prior to the Iran conflict over the last several weeks. And I think it's important to keep in mind as well that trading ranges remain exceptionally tight, and realized vol is failing to deliver.
Okay, got it. And look, finally, Jon, while I've got you, I just wanted to touch on de-dollarization. That's been a theme which has popped up a bit from time to time over the past year or so. But I guess we're not seeing particular signs of that at the moment. What's your take? Have you seen any signs, for example, that global investors are nervous about holding US government debt?
Yeah, de-dollarization is certainly one of those sporadic themes that comes in and out. I think our listeners have surely heard the usual talk on dollar hegemony. There's no substitute as a store of value, means of exchange, size, liquidity of the market, et cetera, et cetera. That's still very important to keep in mind, but so is the point regarding, I think, the strong dollar equity performance, U.S. equity performance. The inflows into U.S. equities and private markets has been robust, and the size of that flow is much more substantial than the foreign reserve manager sort of flows in the treasury market. So even if there are these headlines that put de-dollarization in focus occasionally, I'm not terribly concerned for the time being. Dollar risk reversals went bid in the March of vol, which is a good sign. Yes, there was some foreign official selling flows in March from oil importers in particular, as FX and gold reserves were monetized for liquidity, for currency management, but those flows have slowed to reverse. Are global investors nervous about U.S. debt? Look, longer dated treasury yields have certainly gone up, but they've gone up across developed markets. Fiscal question marks, changing supply-demand dynamics, and challenged hedging properties are all things we're going to have to monitor, but those aren't U.S. specific.
Okay, good one. Hey, Jon, look, let's end it there. I just wanted to say big thank you. I know it's been a big week this week with all the central bank meetings and markets jumping around. So I really appreciate you making the time to share your thoughts. You've given us a lot to think about there. Thanks again.
Of course. Thanks for having me.
Turning next to Europe, Josie Anderson from Nomura's London-based research team is here. Josie, thanks so much. Now, we are recording this on your Thursday afternoon London time. Bank of England and ECB have just met, and goodness, markets have jumped around a little bit. So what's the news from the ECB and BOE?
Yeah, so the headline on the ECB, if I start there, is that it left its deposit rate unchanged at 2%, and that's what we and the markets were expecting. But when we think about what markets were expecting for the rest of the year, well, they were hiking in more than two 25 basis point hikes, possibly three or more before the end of the year. And so that's the situation we had going into this. And in fact, when we read the statement, we thought that was actually marginally more dovish than probably market participants would have expected, given the anticipation of hikes not at this meeting, but later in the year. The ECB emphasized that it's well positioned to navigate current uncertainty. The depot rate is at what it considers to be neutral. And it also did say that longer term inflation expectations remain well anchored. And that comes in contrast to a survey released earlier in the week that did suggest, well, perhaps shorter term, that inflation expectations are starting to rise. But the main thing is the ECB is maintaining a data-dependent and meeting-by-meeting approach. They didn't send very strong signals on what they're going to do later in the year because I think they're just waiting, as most central banks are, for how the war is going to develop and therefore how that will impact inflation. Interestingly, the ECB or President Lagarde did say that they're not currently seeing second round effects, and that will be something that's very important for their decision making. So that's something they're going to be watching out for. But at the margin here, when before the meeting markets were expecting hikes, this speech so far has seemed slightly more dovish.
Okay, and the Bank of England?
Yeah, so there we also saw what we and markets were expecting, which was no change in the policy rate, which is at 3.75%. There was an 8-1 vote. 8 voted to keep rates unchanged. 1, Hugh Pill, voted to hike. That is also what we were expecting. There was no central scenario forecast in its forecast. So this was a forecast update meeting. But interestingly, the Bank of England's presented 3 different scenarios and didn't commit to one of them being its baseline. Again, that just highlights the uncertainty of the situation that we're in. But interestingly, inflation in its forecast falls to around around 1.6 to 1.7% by the end of its horizon. So that is below the 2% target. But what happens in the meantime, crucially, it depends on the Iran war. And we do see scenarios, in particular, the Bank of England's worst case scenario, where the bank rate is hiked several times. But at the same time, at the press conference, Andrew Bailey, I would say, pushed back a little bit against the idea that these scenarios presented which suggest hikes are possible necessarily means that they are going to hike. It didn't seem that they're certainly in a rush to raise the policy rate, of course, because they didn't today.
Wow, that's so interesting. I'm actually smiling. Normally, central banks will have a central case, even with an upside and downside scenario. But yeah, Bank of England just so uncertain they haven't even got a central case for us today. And look, just finally, Josie, looking ahead, Riksbank and Norges in Sweden and Norway will be meeting next week. Could there be any excitement there?
Yeah, I think Norway will be very exciting, actually, because it really could go either way in terms of no change or a hike. At the last meeting, it really surprised markets by signalling that there will be a rate hike at one of the upcoming meetings. And the question really is that the May meeting or the June meeting? We think on balance, it will be June, not this May meeting, but really it could hike the policy rate in May. And the key reason for that actually is not necessarily this energy price shock, which does of course add to inflation, but actually just because the underlying inflation in Norway has been at around 3% for over a year now. And it seems like the policymakers have lost patience with this sticky inflation. So could be May, we think June. For Sweden, it's interesting that underlying inflation pressures are a lot weaker. So it gives the Riksbank a lot more breathing room to see how this war develops before moving the policy rate. It's at the low end of the neutral range at the moment. And so it is on the expansionary side, but inflation is quite weak. In April, there was also a VAT cut to food. And so that means that actually inflation is set to be quite low over the coming months, meaning that there isn't so much pressure to raise the policy rate right now.
Okay, brilliant. Thanks so much. Let's wrap it up there.
Thanks, Andrew.
Now, hopping over to Japan, let's get the latest from Uichiro Nozaki from our Tokyo-based research team. Nozaki-san, thanks for coming back on the podcast once again. I thought this week, I know we're talking week ahead, but we better do a quick BOJ recap. The Bank of Japan met this week, of course. What were the key messages and how does it shape our outlook for the BOJ?
First, the policy rate was left unchanged as expected. However, one surprise was that among the 9 board members, 3 voted for a rate hike. In the outlook report released at the same time, CPI inflation for 2026 was revised significantly higher, and the report also shows core CPI inflation, excluding energy, remaining above 2% all the year through 2028. The balance of risks for inflation was also described as skewed to the upside, reinforcing that this was a hawkish hold. There was also a change in the wording regarding future monetary policy. Until March, the condition for a rate hike had included the phrase improvement in economic activity and prices. But this time, the word improvement was removed. This can be interpreted as suggesting that a rate hike could be possible even in a situation where negative effects on the economy are becoming visible.
Okay, got it. Yeah, a hawkish hold. I thought that was very interesting and important to cover. Interesting too, I guess, on the FX side, although one might think that should give the Japanese yen some support with the stronger US dollar. Dollar yen's pushing higher, so that's a big focus for markets, of course. Finally, just turning to the calendar, the week ahead, it looks like the coming earnings release is a particular highlight. Have you got any thoughts there?
We expect March wage growth to come in at 3% year-on-year, slightly down from February. This mainly because the boost from bonuses was unusually strong in February, and that effect will fall out. While the underlying pace of wage growth is likely to remain broadly unchanged at 3%. For the BOJ, the wage data that matters more is April's rather than March's, because April will reflect the wage increases for the new fiscal year. The April figures will be released before the June policy meeting. Rather than a decisive factor, they are more likely to serve as a supplementary indicator for a rate hike.
Okay, got it. Nozaki-san, that's very clean. Let's leave it there. Hope you have a great week ahead.
Thank you.
Okay, now let's move to Asia. And Iru Chen from Nomura's research team in Singapore is here with us. Iru, welcome to the podcast. So great to have you on.
Thanks, Andrew. It's my pleasure to be here.
Okay, terrific. Looking at the calendar for Asia next week, it looks like CPI data is coming out in a number of countries. So I wanted to get your take. Is there any broad, interesting sort of trends that we could see there?
Yeah, definitely. We will get a bunch of April CPI numbers in the region. So I would say they are pretty interesting to watch how the impact of Iran war has turned out to be. So in general, I would say that we do expect a further pickup in headline inflation as the impact of higher oil prices probably have become more evident in April, especially in those energy-related components. But I would say the extent would vary among countries, largely depending on the fiscal subsidies on fuel, as well as how the government has controlled the prices. So I think Philippines and Thailand are where we would see the largest increase in headline inflation in April, whereas in Taiwan and South Korea, maybe less so. So in the Philippines, we expect headline inflation to jump further to 6.2% in April from 4.1% in March. This is where there are no fiscal subsidies in place. So the impact of the energy price shock is very quick and significant. And in Thailand, we think April would be the month that it got out of deflation for the first time in a year, with headline inflation rising sharply to 2.5%. So this is because the price caps on fuel were actually lifted in late March, and the retail diesel prices have surged after that. And in terms of the impact on core inflation, I would say we think the pass-through will be generally limited in April for most countries, with the exception of the Philippines, where we do expect the spillovers effects to be more broad-based and substantial. And this is probably also why the central bank BSP has already hiked its policy rate last week.
Okay, yeah, so that's really interesting. You've covered a lot of ground there. I guess, Asia in general is impacted by these Middle East developments, but there's an overlay in terms of how the governments have responded with policies. Look, the other highlight I thought looking at the calendar was obviously in Malaysia, Bank Negara, the central bank there, will be meeting. Are they going to hike rates? What are you thinking about that one?
Yeah, so from Malaysia, BNM, we actually think it will be on hold next week. And we think the tone will actually be quite neutral. So Q1 GDP growth has been pretty strong in Malaysia, and BNM has sounded pretty optimistic on the growth outlook in its recent communications, although it did acknowledge the uncertainties from the Middle East conflict. And if you look at inflation, I would say it's still pretty contained in Malaysia, below historical average, given the government is still subsidizing the most widely used petrol. But I would say since domestic demand is robust, BNM probably will continue to signal its vigilance of second-round effects from the energy price shock. But yeah, overall, we think the risks to both growth and inflation are probably quite balanced from the BNM's perspective for now. So no change in the policy rate yet.
Okay, that's great, Iru. Very clear. Hey, thanks so much for joining us.
Thanks, Andrew.
And finally, a quick segue from Bank Negara in Malaysia. The Reserve Bank of Australia will also be out next week with a rate announcement, along with an updated quarterly statement and fresh forecasts. And in contrast with Bank Negara, we do expect the RBA to deliver a 25 basis point rate hike on 5 May. That would be a third consecutive hike, taking the official cash rate to 4.35%. Our confidence in this call has slipped a little. We'd suggest a 60-65% probability of that. That's actually a bit less than the market is currently pricing following below consensus CPI data this week. But still, annual headline inflation of 4.6% year over year is almost double the midpoint of the RBA's target band and likely heading higher too, given recent oil developments, which also present upside risks in terms of inflation expectations. And ultimately, we expect the RBA to judge it necessary to deliver another hike in order to be more confident that financial conditions will be sufficiently restrictive to return inflation to target in a timeframe it can live with. In terms of those updated forecasts, we expect modest downgrades to GDP estimates, but more notable upgrades to CPI forecasts, as we've seen elsewhere. And for Australia, we're also expecting to see some pass-through from headline to core inflation too. Okay, so there you have it, our views on key developments, major market themes, and what to look out for next week. This podcast has been written by Andrew Ticehurst and the Global Markets Research team and edited and produced, as always, by John Dalton, who is both talented and patient. Thanks, John, and thanks for listening in, all. If you did enjoy this podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud, or wherever you get your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log on to nomurakonnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomurakonnects.com.